Hello, this is problem 9-29, which is from chapter 9, obviously, and I'm going to attack the last problem, which is the hardest one, and hopefully you'll be able to see and translate this to where information comes from and where it goes through, remembering that we are doing a master budget, which turns out to be a highly useful instrument for many different reasons. I was just listening to Marketplace today, which is one of my favorite shows, and they were talking about a company going IPO and what is the thing that the company needs to be able to present themselves on the stock market. Well, they need a budget, and they needed a budgeted income statement to show what their projected earnings are going to be. So here we are. Look at this. That's exactly what we're learning to do today. Okay, so this is just the information that's given, and then we need to first come up with a schedule of expected cash collections. So as you may or may not know, I have created a spreadsheet just for you on problem 9-29. Why? A, because I love spreadsheets, and B, because I think it will help you. So I'm going to continue to work in the spreadsheet, but once you get all the information, then that would be able to easily transfer over to Connect. All right, so here we go. The first step is that it tells us that sales are 20% cash and 80% on credit. All payments on credit sales are going to be collected in the month following the sale. So that's why I first want to come up with, well, how much of a sale in December, January, February, whatever, how much of that was cash and how much of that was credit. So here I go. And all I'm going to do here is take it over here, and I'm going to say, well, I'll start actually in January since we're going to do the first quarter. So I'm going to take January and I'm going to multiply that times the 20%. All right, that gives me $80,000. What's that represent? That represents the amount of the January sales that are going to be collected in cash. So what's the credit portion? Well, it would be that same number multiplied times the 80%. One little Excel trick you may have noticed is that I froze C2. What the heck is C2? C2 is where I'm getting my 20%. So actually, if I take this formula, which basically says multiply this number times 20%, and if I copy this down, guess what's going to happen? Is it's going to take this number multiplied by 20%, this number times 20%, give me here, and so on and so forth. Isn't that fun? And I did the same over here. You can see I anchored D2. What's in D2? That's the 80%. So if I take this number and copy it on down, and guess what? There's my numbers. All right, so the next part is, what are my cash collections? How much in cash am I going to take in? So there's a beginning balance. Where was there a beginning balance? Well, because if you see back here in December, we had $280,000. And if you remember properly, 20% of that $280,000 would have been collected when? Yes, in December, which means 80% of that will be collected the following month, and the following month happens to be January, right? So that's why we're going to begin with a cash balance here. Now, if you want to just take the easy way out, you could also look at accounts receivable, and that will be the same number. Why? Well, because that's the money we're actually, that's how it wound up on the books, is that of the sales, some of it was in cash, some of it was on credit. That on credit, that amount that is going to be due us from our customers is called accounts receivable. We all remember that. So again, I could have taken it from the accounts receivable balance. I happen to take it from December's number, and I'm going to multiply that times 80%, and I'm going to come up with $224,000, which is the same as the AR balance. Okay, so let's carry on. How much money am I going to receive in January from January sales? Well, we just figured out how much was our cash portion that we were going to collect and what our credit portion was. So here, since it's January and we're talking about January sales and we're talking about the cash portion of January sales, that's how much cash we're going to collect in January. Okay? How much of January credit sales am I going to collect in January? How about none, right? When are we going to collect those? We're going to collect those in February. So how much of those are we going to collect in February? All of the credit sales of January are going to be collected in February. Okay, so let's look at February. How much of cash portions of January sales are we going to collect in February? Zippo zilch, right? But we do have February sales, and the cash portion of the February sales will be collected in February. So here I go, boom. And then the February credit sales will be collected in March, which is over here. So I'm going to take February's sales, the credit portion, and I'm going to collect that in March. Okay, so the March, once we get to March, how much March sales are we going to have? Yep, there are our March sales right there. And then what's going to happen is, I'll make a little note over here. I'm going to just scoot that over just a little bit, because how much is going to be my AR balance at the end of the quarter, right? It's going to be the credit sales from March, and then I totaled it down at the bottom. So let me just make sure that everything is right. So this is not right, because look at this, February should be over here. Yep, and there you go. So if you caught my little error, then you know that you're on the right track. Okay, so those are our total cash collections. All right, let's move on to the purchases. So we know that's how much we're going to sell. Well, how much did it cost us to sell those things? All right, so back over here in the information that was given, it says the company's gross margin is 40%. That means if their gross margin is 40%, they take 60% of the sales, and that would be the cost of goods sold, right? It's either gross margin or it's cost of goods sales. So, you know, because sales less cost of goods sold equals the gross margin. All right, so how much were our budgeted cost of goods sold for the month of January? So here it's important to remember that we must go back to our sales. Okay, so this was all fine that we know how much cash we're collecting, but now I've got to figure out, of my January sales, which are here, how much of that is going to go to cost of goods sold. And as we remember, the company's cost of goods sold is 60% of the sales. So the budgeted cost of goods sold for January is going to go back up to January sales numbers, and we're going to multiply that times 60%. Okay? Now, the next part is it says, well, okay, let's do for February first before I get into the ending inventory. So February, we're going to go back up to February's numbers, which are here, and multiply those times 60%. Oops, well, that couldn't have been right. Let's take it again. February sales, and we're going to multiply those times 60%, and there we go. And March's sales, same deal. We're going to take those and multiply them times 60%. Okay. And you can see that we're coming up with a quarterly as well. Now, when it comes to the desired ending inventory, the information that was given to us is down here. It says for each month's ending inventory, it should be 25% of next month's cost of goods sold. So, well, that seems pretty straightforward. For January, I need next month's cost of goods sold, which is here, and I need 25% of that. So I'm going to take this and multiply it times 25%, and that's my desired ending inventory for January. Okay, all I'm doing here, very simple. I'm looking forward to February, and I'm saying, what do I need in February so that I can open my doors on February 1st and have something there. I always need to have a little on hand. So that's all that means. So my total needs are my budgeted cost of goods sold plus my total needs. All right, what was my beginning inventory for the year? All right, we got to think about this. It's actually pretty easy. We can do it one of two ways. You can either look at the inventory information that was given here, or you can think as if you were back in December. So here I am back in December, and I say, I need to have on hand 25% of January's cost of goods sold in December. So that would have been my ending inventory in December, which also becomes my beginning inventory for January, right? So I'm going to just do this. I'm going to say, well, that I know is my cost of goods sold, my budgeted cost of goods sold for January, and how much do I need of that on hand? I need 25%. And boom, do you see how that works? That's pretty cool. All right, then we're going to take our total needs less what our beginning inventory was, and that's how many things we need to purchase to be able to satisfy our sales demand, plus have some on hand for next month. All right, so then when we move forward to February, this should be pretty good. So what's my desired ending inventory for February? It's simply March times 25%. My total needs. All right, what was my beginning inventory for February? It was my ending inventory from January. Required purchases are my total needs less what I already had on hand, and there you have it. Okay, so what's my desired ending inventory for March? Well, now I kind of need April's numbers, don't I? Let's go back up here and look at that. They gave it to us. Wow, $200,000. So I'm going to take that $200,000. Now this is kind of tricky because remember, that's not the cost of goods sold. The cost of goods sold is actually 60% of sales, and I need 25% of that. So that should be my desired ending inventory. And then I do the same thing with this. Okay, what was my beginning inventory for March? It was my ending inventory from February. Boom, there you go. This less this gives me 165, and then the quarter comes along in here. Okay, so now we know what our required purchases are. So the next part says, all right, well, for cash disbursements, in other words, when am I going to pay for this stuff? It tells me in the problem, each one half of the inventory purchases is paid for in the month that it's purchased, and the other half is paid for in the following month with which it's purchased. Okay, so December purchases, we could have calculated that out just like we've been doing everything else, or you can take a look and see that there is an accounts payable balance. So I'm going to just use it this time for brevity. So there's my December purchases right there. How much are my January purchases? So my January purchases were $270,000. So if I come up over here, I'm going to take 270. However, I'm only going to pay for 50% of that in January. When am I going to pay the other? I'm going to pay that in February. So I'll just transfer that amount also to February. Okay. What about, one thing would be really nice. So if I took this, copied it over here so we know what month we're in. Okay, good. So for February, how much of that is going to be a cash disbursement for my purchases in February? So here, I thought I needed to purchase $315,000. I'm just going to take 50% of that I'm going to pay in February, and then I'll go ahead and follow up and pay that same amount or the other 50% in March. Okay, so what about my March purchases? My March purchases are $165. I'm going to multiply that times 50%, and that's how much my purchases are in March, which leaves me, I'm going to move this over a little bit, my AP balance is going to be 82. That doesn't need a dot, that needs a comma. 82,500. Why is it accounts payable? Because I owe it, right? So that's going to be really good information later. So remember, we're going to hang on to this, and then we also are going to hang on to that. Maybe I'll wrap that. There you go. Okay. Now I'm going to create a cash budget. So I'm basically going to look at all of the money that's coming in and subtract the money that's going out and figure out if I actually need to take a loan out for things that look like they're going to be shortages that month. So we're going to go ahead and start this cash budget out. Again, I'll take this like this. Okay, so my beginning cash balance was actually given to me. There it is right there, $48,000. So I'll go ahead and type that in there. Now, what were my cash collections? My cash collections, I'm going to find way back up here. There's my cash collections for January. All right, so my cash available would be what I started with plus what I think I'm going to put in. And then my cash disbursements are going to be actually what I think I'm going to spend. So if I look back up here on my cash disbursements, and one little thing I forgot to do over here was actually come up with a total for my merchandise, my cash disbursements for my merchandise. So I'm going to go ahead and do that here. So this plus this is that, okay? And I'm going to do the same over here. I'm going to add up everything over here, And I'm going to add up everything for March. Okay, because those numbers are now going to come down. So how much are my merchandise purchases for January? It's this amount, right? What are my selling and administrative expenses? So over here, it says somewhere, it says that monthly expenses are salaries and wages. For 27, that's a fixed. Monthly advertising is fixed. Plus there are variable expenses of 5% and 3%, and there's some depreciation, which is going to come in handy, of $42,000. So we basically got $27,000 fixed plus $70,000 fixed plus variable of 5 plus 3 or plus 8. So in this one, I'm going to take my $27,000, which is my fixed, plus my $70,000, which is also my fixed, plus 5% of my sales number, which is way back up here for January. Oh, for January. Let me try that again. Let's see. Plus multiplied times B5, which is over here. I'm going to close my parenthesis, and I come up with 117. I had one little typo in here. I'm going to make sure I fix that. 8%. Okay, so that's what we get. Now, the problem also mentioned to us that we would be paying some property taxes. Excuse me, so we were going to be purchasing some equipment, so let me get back to that part. But they did tell us that they were going to declare a $45,000 cash dividend in January, so we'll go ahead and indicate that here, okay? And then what we're going to do is we will add up our total cash disbursements, which would be the merchandise spending plus the selling and administrative plus any equipment plus our cash dividend, and that's going to give us $402,000. So that's how much we're going to disperse. Let's take a look and see, well, if we're going to disperse, if we're going to take in $352,000 and we're going to disperse 402, look what happens. Oh my gosh, we are over. So we need to finance, and the problem actually states that the management wants to maintain a minimum cash balance of $30,000. So we're way off here because obviously we're in the hole. So in order for us to get to that $30,000 magical cash balance, we now need to borrow $80,000. Would you agree? Because then it'll cover the $50,000 that we're short, plus also give us a $30,000 cushion. Okay, so we're not going to repay or pay any interest now because obviously that's, you know, we just borrowed. So then we're going to take the sum of all of these things, which is obviously $80,000. Now we're going to take what we were deficient and add that to our borrowings, and now you can see that our ending cash balance is $30,000. So let's go to February, because guess what? Now our February starting balance is January's ending balance, and then we're going to pretty much do the same thing here. So what are my cash collections for February? I'm going to come back up to my cash collections for my cash collections for February would be 440. So the cash I have available will be what I'm collecting plus my beginning balance. There's my 470. So what am I going to purchase for inventory? So my merchandise purchases, I'm going to go back up to my merchandise purchasing, which for February would be 315, and then I'm going to take, they are actually, I grabbed the wrong thing. They are actually coming from my cash disbursements right here, not from my purchases. And then my selling and administrative is going to be that same 27,000 plus the 70,000. Those were both the fixed portions plus, plus I'm going to add 0.8% and multiply that times the amount of my sales in February, which if I come back up here, February's would be here, close my parenthesis, and I come up with $145,000. Okay, then They told me that they're going to purchase a new copy machine in February, so I'm going to go ahead and add that $1,700 for my February. No cash dividends. My cash disbursements are going to be my merchandise purchases plus my selling and administrative plus whatever equipment, and there are my total cash disbursements. So now if I take it, well, I took in $470 and I spent $439, so hallelujah, I am now in a positive territory. However, I'm not in a positive enough territory to repay the loan because remember I borrowed $80,000. So for this month, I'm just going to play it cool, right? So I'm going to take this, nothing happens over here, so now I'm just going to take this and copy it over, and you can just see that my $30,800 flows all the way down. Now this is going to become my beginning balance for March, so I'm going to go grab the ending balance for February. I'm going to add my cash collections up here. So if I go back up to my cash collections, and there they are. Okay, and then I add those two things together. And my merchandise purchases are now going to be the $240 for March. My selling and administrative again are going to be the $27,000 plus the $70,000 plus 8% of my March sales. If I come back up here, there's my March sales. And boom, I've got $121,000. Now, did I have anything else go on purchases wise? They're going to purchase a new copy machine. We got that. Other equipment will be purchased for $84,500. So that is going to go right here. Okay, any cash dividends in March? No, the only one they did was in January. So we should be good to go. So let's go ahead and take our merchandise purchases and our selling and administrative and our expenses for the equipment. And now what do I look like? So now I've taken in $570 and I've spent $445. That gives me, now I'm finally talking in the positive territory. So guess what? Now that I have enough to repay the loan and still maintain a balance of $30,000, I'm going to go ahead and repay that. So now I'm just going to repay the $80,000 that I borrowed over here, and now I've got to figure out how much interest I owe. So what did they tell me? Let's see. The interest rate on these loans is 1% per month, and it's not compounded, it's just simple interest. So if I take $80,000 and I multiply that times the 1% and I multiply that times the 3 months that it was outstanding, I come up with $2,400. Okay, and that's also going to be a negative because I have to repay that, right? That's not money coming in, that's money going out. All right, so now if I take this, I should come up with a minus 82.4. That's money going out. So now I'm going to take my total cash that I have and I'm going to add that to the repayments. I'm going to come up with $42,900, and that's how my cash budget works. So now we're going to get to the income statement. So my sales, how do I get my sales? Well, if I actually copied it down here, do you see how I have January, February, March? So if I take 400,000 plus 600,000 plus 300,000, that gives me $1.3 million, right? Oops, except I forgot a zero, so let's add one more. There we go. All right, and now it's just and I should put that in the right place. So now I have beginning inventory. Where am I going to get my beginning inventory? Well, that should have been way up here. And there's my beginning inventory, $60,000. So I'm going to go ahead and take that. There's my beginning inventory. All right, how much are my purchases? So my purchases are going to come from my purchasing schedule. And because we're doing a quarterly, we're going to go ahead and grab the entire required purchases for the quarter. So that's going to come down over here. Our goods available for sale are what we started with, plus all the things we brought in for a purchase. Oh, what's our ending inventory? So if we look back up over here, our ending inventory will be the ending inventory for the quarter, otherwise known as $30,000. And then for convenience, we're going to go ahead and add all of these things up like such. So here I took my goods available for sale less my ending inventory, and that gives me my total costs. So my gross margin is going to be what my sales are. In fact, I'm going to move this over just for alignment purposes. So my cost of my gross margin is going to be, in fact, I can move that down. Connect will be just slightly different on how the alignment goes, but here we go. So there are my sales, there's my cost of goods sold, and there's my gross margin. So then I just come down and I do my salaries and wages. One important safety tip about this, the selling and administrative, is even though they didn't break it up, even though they didn't break it up before, they're now going to be itemizing it down below. So if you remember, it's not too bad though. Do you remember we had, just recall that over here it tells us that we had salaries and wages of $27,000 a month, advertising of $70,000 a month. So all it's asking us to do over here is itemize those things, and I think we can do that. So if we take $27,000 and we multiply it times 3, why times 3? Because that's how many months we're in this quarter. We come up with this. Same deal if I add my $70,000 and I multiply that times the 3, then I'll come up with that. Shipping was the 5% of the sales, so we're going to take 5% and we're going to come back over here and we're going to find out what our total sales are for the quarter. So here I'm just going to take my sales and I'm going to multiply that times 5%. And the same with the other expenses, which were listed at 3%. So here I've got my sales and I'm going to multiply that times 3%. Okay, then depreciation is the last item, and it tells us at the end of the quarter that, here I'll get this back over here so you can see that at the end of the quarter it will be $42,000 for the quarter. So it says depreciation, yada yada yada, will be $42,000 for the quarter. Okay, so I simply took the $42,000 that they gave me. Here we go, and then I'm going to add up all of my expenses. So if you take all of these, you come up with $437. Your net operating income is going to be your gross margin less all of those expenses, otherwise known as $83,000. Your interest expense, that came from the amount we calculated here, only it's not a negative, so we'll go ahead and just make that a positive. All right, so 24,000. I'll win. Okay, there we go. So then my final net income is going to be my net operating income less my interest expenses. All right, now moving on to the balance sheet. I'm going to start out with my balance sheet. We're going to take the cash. Where do we get our cash? We get our cash from the ending balance of cash on our cash budget. So there's our $42,900 right there. So that's where we're going to take that. Okay, our accounts receivable is from what we are anticipating to receive in the following month, which would be April, which is $240,000, which is the credit portion of our March sales that we're going to receive in April. So that's where the $240 comes from. So we're going to go ahead and do that. Okay, where is our ending inventory? If we look back up over here, our ending inventory is going to be our desired ending inventory right there of 30,000. And then, oops, excuse me, 30,000, and then we're just going to add all that together. Okay, our buildings and equipment, if you recall, back over here, our buildings and equipment were $370, and to that we added, remember we purchased some more equipment for $86,200, and then we had some depreciation of $42,000. So basically we're going to take our 370 that we started with, we're going to take the 86,200 that we added, and we're going to subtract our depreciation because it just wanted the net. Oh, let's see, it always gets upset at me. There we go. Okay, so then my total assets are going to be my current assets plus my long-term assets, and hopefully that is right. And it is. Good. Okay, so here, I'm going to do this, I'm going to wrap this. Okay, so okay, so my liabilities and stockholders' equity, what are my current liabilities? For this problem, the only current liabilities I have are my accounts payable. So we made a little note up there about what our accounts payable balance was based on what we had to pay for the next month, which was the, I'll write this in here, oops, AP, and it was 82.5. That represented half of what we needed to pay for our March sales that we're going to pay in April. All right, so it said that we had common stock of $50,000, and our retained earnings is going to be whatever our ending retained earnings was, which was $109,100, and then we're going to add in our net income, which is, so I'll do this over on this side here. Let's see, our beginning retained earnings was 109, so let's come down over here where we can kind of make some notes. So 109,000, and then we had some net income of 80,600, so we can add in the 80,600, but then we had some dividends. If we look back up here in January, we declared some dividends of $45,000. So then we're going to subtract our $45,000, and that right there is going to give us our retained earnings. So I'll do this in a formula. 600 minus the 45,000, and that gives me 144.6. And then I'm going to add my 144.6. So my final entry is going to be to add in my stockholders' equity portion, which is the retained earnings and the common stock, and add that to my liabilities, and holy moly, look at that, I balance. So we're all done.